outside the supplier, he offered you the 20,000 units of this 4A part 4A at $25. So it costs you $30 and he's giving you at $25. So should you buy from this supplier or should you make? Let's talk about this. So remember this differential statement here, make or buy decision. So you are making 20,000 units, right? So the direct material going to be 20,000 multiplied by 9, answer is 180,000. Direct labor cost 100,000. Depreciation, no. General factory overhead, it's the same whether you do or not. You just multiply it, or you can just calculate it, all these values. 9 is relevant, yes, it's relevant. Direct labor is relevant, yes, it's relevant. Variable cost relevant, yes. How much? It's total 15. Depreciation is not. Supervisor salary, yes. And general and factory administrative, no. So you can just say that 9 plus 5 plus 1, 15 plus 2, 17. It cost you $17 and he is giving us at $25. And if you want to have a total figure comparison, you can say that 180,000, 100,000, 20,000, 2 multiplied by 20,000 is 40,000. So total is 340,000 as compared to a buy decision of 500,000. So the avoidable costs associated with making part 4 include the direct material, direct labor, variable cost, and the supervisor salary. That's it, the 4 costs, which are these, not these, right? In that sense, you are essentially making the product at 17 multiplied by 20,000, answer is 340,000. So you can also base your comparison like this. So what is the decision rule here? Make rather than purchase from outside. So the depreciation cost of special equipment represent a sunk cost, and sunk cost is always not relevant. So the equipment has no resale value, plus its cost and associated depreciation are irrelevant to the decision making. Right, guys? Do you understand? Make or buy decision? Ayana, Crystal, Jackie, Leo, Minsu, Timay,
Yes.
Sun, Stella?
Yes.
Yes.
Okay. The general factory overhead, it is unavoidable and irrelevant. Why? Because the question itself says that whether you make or buy, you still have to be allocated this general factory overhead. So that's why it is irrelevant. Okay. So the concept of opportunity cost. We already know that opportunity cost is foregone, the benefit from foregone opportunity or foregone alternative. So an opportunity cost is the benefit that is foregone as a result of pursuing some course of action. Opportunity costs are not actual costs, are not actual cash outlays, and are not recorded in formal accounts of an organization. So how would this concept potentially relate to this company? Let's see that. So when you prepare an analysis showing whether a special order should be accepted or not, we'll talk about this as an opportunity cost. Here we go. So let's talk about the key terms: special order, The special order is a one-time order which do not disturb your existing ongoing or normal business. It's a one-time order, and it's not going to be disturb your existing customers or existing business. So when we are analyzing a special order, only the incremental costs and benefits, they are relevant. So any question? Here we go. So since the existing fixed manufacturing overhead costs would not be affected by the order, they are not relevant. So essentially what we are trying to do here, so when we have a special order, remember the fixed cost becomes irrelevant. So let's talk about example here. So we have a jet incorporation that makes a single product whose normal selling price is 20. A foreign distributor offers to purchase 3,000 units, 10 per unit. So he's giving us, he is quoting us half of the price. The selling price is 20, and now the foreign distributor is telling us, I'm gonna buy at 10 per unit. The question says that this is not a normal business, this is a one-time order, right? And company have the capacity 10,000 units, and he's only producing 5,000 units. So in order to see that whether we can afford this special order, a couple of things must keep in mind. First of all, you have the capacity. So you are utilizing your capacity 5,000, and you still have 5,000 more. And he's asking 3,000 units. Can you fulfill that? Answer is yes. Now the second one is it should be one time. It's not the normal business. The third one is you eliminate all fixed cost, because it's a one-time game. You still are paying the rent, you still are paying the salaries, only incremental cost is going to be there. Here we go. So this is the Jet Incorporation income statement with respect to contribution margin income statement. So we have all the variable cost and we have all the fixed cost. So this is a one-time game. So when we have a one-time game, fixed costs become irrelevant. Let's talk about this. So we have 8 is a total variable cost. When fixed costs become irrelevant, so all the variable costs become relevant. So how much is the total variable cost? 40,000. And how much the units? We are producing right now 5,000. So our variable cost is 8, right? And he is giving us $10. 8 is our variable cost. How much he needs? He needs 3,000 units. 3,000 units is going to give us 30,000 revenue, and the cost is going to be 24,000. So it still saves us 6,000. So should we accept? The answer is yes, we should accept it, as we assume that fixed costs are unavoidable because it's a special order. Only variable marketing cost must be incurred on special order. Now question arises that whether we should include this marketing cost or not. Because it's a one-time order, the question is, this is a part of variable expense. Maybe we incurred a special variable cost to gather this special order. to get this special order. That's it. Since it's about a variable cost, so we cannot avoid that. Only the fixed marketing expenses is going to be avoided. This 20,000, we are not going to use that. Manufacturing overhead, we are not going to use that because factory still runs at half of its capacity. We are paying the rent. Only the incremental cost going to be incurred, that is 8 per dollar, and it's going to save us $2. So $2 multiplied by the 3,000, answer is 6,000. So relevant costing help us to decide, whether we can drop off a segment or we can continue the segment, whether we can have a special order to accept that or not, or whether we can buy and buy a part from outside, or whether we can make a part of the product for ourselves, right? Here we go. So a quick check. I'm going to be solving this illustration with you, and then we are going to have our breakout room activity as well. So here we go. So Northern Optical ordinarily sells X lens for $50. The variable production cost is 10. The fixed production cost is 18. The variable selling is 1. Sorry guys. The customer has requested a special order of 10,000 units of the X lens to be imprinted with a customer logo. This special order would not involve any selling cost, right? But Northern Optical have to purchase the machine of $50,000. So what is the rock bottom minimum price below which the Northern Optical should not go in its negotiation with the customer? In other words, below what price would Northern Optical actually be losing money on the sale? There is ample idle capacity to fulfill the order, and the imprinting machine has no further value. So look at that. We have a variable cost 10, right? He